back to our recorded discussion. We are still in time value of money, but now I will be presenting the present value computation. Okay, so I am your discussant, Professor Rebecca Armakiling. So present value. Present value is nothing but how much future sum of money worth today. We know that our money today is different for our money tomorrow, okay? So present value provides us with an estimated amount to be spent today to have an investment worth a certain amount of money at a specific point in the future. Present value is also called the discounted value. So it is an indicator for investors that whatever money he will receive today can earn a return in the future. With the help of present value method, investors calculate the present value of a firm's expected cash flow to decide if a stock is worth to invest today or not. Okay, so our formula is present value is equal to future value divided by 1 plus r raised to the n power. Or we can do this by using the other formula, present value is equal to future value times 1 plus r raised to the negative n power. 1 plus r raised to the negative n power is our present value factor. Okay, present value factor of 1. So where PV is the present value, FB is the future value, R is the interest rate, and N is period or time. Okay, now let's look on our example. Suppose a Bangko Sentral ng Pilipinas bond will pay 2 million 10 years from now. So if the going interest on these 5-year bonds is 3.5%, how much is the bond worth today? So meaning you will have 2 million 10 years from now, but the question here is that 2 million is how much is that worth today? Okay, so take note, in present value we are discounting because our money today is different on our money in the future. Okay, so our formula, FB is equal to PV times 1 plus R raised to the negative N. So put the future value, which is 2 million, times the rate 1.035 raised to the negative 5. So our present value is 1,683,946.33. So take note, it's not already 2 million. Okay, so it's already 1,683,946.33, which is lesser than the 2 million. So that's the value of our money, So if you are using a non-specific scientific calculator, first is compute first the present value factor of 1. So 1 plus r, okay? 1 plus r, then 1 divided by 1 plus r. 1 divided by 1.035, and then equals, you count for how many years? So 5 years. So 1 divided by 1.035 equals, and then 1 divided by 1 divided by 1.035. Okay, and then divided by it again with 1.035. So it's already in the second year, then equals only third, fourth, and fifth. So in the fifth year, our present value factor of 1 is 0.841973, and so on. So just get the 5 digits. And then times it with your future value, which is 2 million. Okay, so our answer is 1,683,946, and so on, because of rounding off. Okay, now another example of our present value. So what is the present value of $100 due in 3 years? So meaning you can receive the $100 in 3 years, or it could be you will pay it in 3 years, no? So it depends upon the situation whether you invest it or whether you will pay for it. Okay, if the interest rate is 4%. So finding the present value of a cash flow or series of cash flow is called discounting. This is the reverse of compounding. So the present value shows the value of cash flows in terms of today's purchasing power. So using the time series, so yung 100 due, which is yung babayaran mo, so this is due man kasi, so babayaran mo within 3 years, so magkano daw yung present value it for today? So take note, iba yung value natin, no? Value ng money ngayon at saka value ng money in the future. Okay, so look on it. By using the formula, plug in the formula, present value is equal to future value divided by 1 plus r raised to the n, or present value time is equal to future value times 1 plus r raised to the negative n power. So take note, if you are using division, your n is positive, but if you are using multiplication, your n is negative. Anyway, they have the same answer, which is 88.90. Okay, if you're using Excel formula, so your formula would be PV, PV, then tapos open parenthesis rate, net, and per payment FB type. Okay, so, but we will encourage you to use the formula and using also the non-scientific calculator. Okay, so if it is a non-scientific calculator, what you will do, 1.04, and then 1 divided by 1.04, divided by it again with 1.04, that is already for 2 years, and then our year is 3, so just press another equal sign. So 0.8889 times, then times it with $100, so 88.90. So anyway, we have still the same answer. Now let's go to the present value of ordinary annuity and present value annuity due. Just like the future value ordinary annuity and future value annuity due, this is installment type. Okay, so cash installment, no, that are made over a certain period of time. So in an ordinary annuity, the payments is distributed at the end of the pay period, while the present value annuity due, the payment is received or paid immediately. So today, into an annuity today. So meaning to say you pay it today. Okay? So that's the essence of it, no? So our formula for the present value ordinary annuity, we have future value times the present value annuity of 1, or the present value annuity of 1, which is 1 minus 1 over 1 plus r raised to the n, and then you divide it with r, or 1 minus 1 plus r raised to the negative n divided by r. So it depends upon you, which is wherever you are comfortable. Okay, now for present value annuity due, your formula would be the present value, the future value times the present value factor annuity of 1, which is 1 minus 1 divided by 1 plus r raised to the n over r, and then again multiply it with 1 plus r. Okay, so whichever you are comfortable. So if you are using a non-scientific calculator, so first is you compute for the 1 plus r raised to the negative n. So 1 plus, for example, 4%, 1.04, and then divide it, 1 divided by 1.04, and then divide it with again with 1.04, and then until to the end period, and then after that 1 minus the answer of it, and then divided by with r with with 0.04 before you will multiply it with the future value. Okay, so example of the present value ordinary annuity and annuity due. Assume a person has the opportunity to receive an ordinary annuity that pays 50,000 per year for the next 25 years. So the present value problems are more on retirement, no? Or it could be payment also, no? Though payment for something. So 50,000 per year for the next 25 years with a 6% discount rate. So if there is already discount rate, meaning you are using present value. But if it is compounding rate, you are using the future value. Or taking a 650 lump sum payment, which is better option. So here there are two alternatives, whether to receive the $650,000 in lump sum payment or receive it per year for the next 25 years. Okay? But there is a discount of 6%. So which is better option? So using the above formula, you use the present value annuity. So you can receive it 50,000 times the present value factor of annuity of 1. So yung previous nga formula na lang natin, 1 plus 0.06. So 1.06 raised to negative 25. And then 1 minus answer divided by 0.06. Okay, that is 12.783356168 our present value or the present value factor of ordinary annuity of 1. Then multiply it with your future value, which is 50,000. Okay, so answer is $639,168. Given that information, when you compare it to the lump sum, which is 650,000 lump sum payments, of course, I will choose the lump sum payment compared to the per year, no, within 25 years. But for the lump sum payment, you can only receive it after 25 years. Okay, so for the next 25 years, so after the end of the next 25 years, so which is better, whether you want this one or not. So it depends upon the situation. How about if you will receive the annuity due? Meaning to say you will receive it at the beginning of each period, not on the end of the period. So you use the present value annuity due. Okay? So our formula, just multiply it with 1 plus R. So given the formula above, 639,168 times 1.06. So that is $677,518. So in this case, you may choose either you depende sa imo no, so either you want to take the lump sum 650,000, either you will take it after at the end of the year 50,000 for 25 years, or you will receive it beginning. So if that is the case, I will choose the annuity due, no, because it's great, it's higher, no, compared to the lump sum, which is 650,000 lump sum payment. Next, another example of present value of ordinary annuity and present value annuity due. Assume a person has the opportunity to receive an ordinary annuity that pays 50,000, as still the same with our problem while ago, but now we are using um, another method, no? Which is presented here is yung if the formula given or the present value factor given in your examination is only for 24 years or for 25 years. So how would you do it? So this is for annuity due, okay? So um, recall our formula for present value ordinary and annuity. Present value annuity due is yung future value multiply with the present value annuity of 1, no? Present value factor annuity of 1, which is for 25 years. Pero ito, 24 years ang gigamit niya kasi it depends upon the problem, no? Kung given lang 24, not 25 years. And then this annuity due, just add back the 50,000, okay? So ito, no? Present value is equal to the payment, which is 50,000 plus the 50,000 times the present value value interest factor or present value factor of ordinary annuity for 24 years. So it's still the same. We got $677,518. Okay, I will choose this one compared to the first one. Okay, what is the difference between an ordinary annuity and annuity due? Just like yung future value natin na lessons, so only on the payment, no? If it's annuity due, the payment or the installment is given or paid at the zero period, while on ordinary annuity at the end, no? Okay, yan ang ating difference. An annuity can be a useful tool when planning for retirement. So after you stop working, you'll be relying on your savings, social security payment to support yourself and enjoy your golden years. So purchasing an annuity creates an additional income stream which can make things easier. So again, you need to choose what particular investment you like, no? Whether you want to receive it installment or you want to receive it full, no, lump sum. And then depends also whether you want to receive it at the beginning of the year or at the end of the year. You need to compute, no? So in our example, it is better if you receive its installment. You can receive it at the beginning of the year, not on the end of the year because of the time value of money. Okay, thank you so much. And then um, just wait for our next recorded discussion about payment, interest, effective interest rate, and so on.